British Steel to shut its blast furnaces in Scunthorpe, putting potentially 2,000 jobs at risk. Ryanair to reward shareholders with regular dividends as the low-cost airline's post-COVID recovery continues. Plus, the UK's house building activity shrinks for the 11th month in a row. Good afternoon. This is Business Live with me, Ian King. British Steel has confirmed plans to close the blast furnaces at its plant in Scunthorpe. The Chinese-owned company says the move is part of its plans to reduce carbon emissions. Well, British Steel said in a statement, "We are confident our proposals will help secure the low-embedded carbon steel making the UK requires now and for decades to come. However, we need the UK to adopt the correct policies and frameworks now to back our decarbonisation drive. We remain in talks with the government and, with its support, are committed to making the steel Britain needs for generations to come." Well, the £1.25 billion proposals would see the blast furnace replaced by 2 electric arc furnaces, one in Scunthorpe and another in Teesside. Unions say they fear up to 2,000 jobs could be lost as a result of the decision. Well, joining me now from Scunthorpe is Charlotte Brumpton-Childs, National Officer at the GMB Union. Charlotte, welcome to you. I mean, this, of course, is contingent on government support. What are you hearing on that front?
Very little. Holly Mumby-Croft, the Tory MP for Scunthorpe, is just behind me there. And I asked her how close we were to a deal. There's very little being said at this point. But I'm expecting something to be similar to the scale that they've had at Port Talbot for Tata Steel promised to British Steel.
And for those who aren't up on how the steel industry operates, why does replacing a blast furnace with an electric arc furnace result in fewer jobs?
So arc furnaces fundamentally need fewer people to run them. But fundamentally, you can't make the same amount of or the same amount of grades of steel that you can with blast furnace steel. The technology just isn't there. That's why all 3 unions are advocating for a hybrid approach to decarbonised steel making that retains blast furnaces in the short term while utilising technology like hydrogen and direct reduced iron to supplement an electric arc furnace steel making proposal to ensure that we can continue to have a diverse range of steel on offer and to safeguard and protect the jobs moving forward.
Isn't the problem with that, though, that's potentially going to cost more money? I mean, as things stand, the plant is losing £1 million a day, and that's less environmentally friendly than going for a pure electric arc furnace approach.
Well, not necessarily. I think a lot of the electric arc furnace approach and the feed that our mills need will still require us to import carbon-heavy steels into the UK. We're just offshoring our carbon responsibilities, and with that offshoring the jobs that come with them, there is a long-term plan to be able to decarbonise the steel industry, and all the unions accept that the industry does need to be decarbonised. In fact, we've been lobbying the government to take decisive action on this for a number of years now. I'm afraid that these decisions that are now being made are short-termism in the worst degree and will not secure steel making for the future, not in any real scale to what we see today, and will also potentially put at risk the UK's ability to make virgin steel on our shores.
Charlotte, while we have you, we've just learned in the last few minutes that the government is planning minimal service levels for rail, ambulance and border security staff to minimise disruption in the event of strikes. I just wonder whether you could give me some reaction to that, please.
We already operate minimum service levels in many of those sectors. You'll have seen in the NHS strikes that happened earlier on in the year that we ensured that there were minimum staffing levels. Ambulances still reacted to the most serious of accidents when the ambulance staff were on strike. We think that the government's approach to this is the wrong one. They need to get round the table and be negotiating effectively with the trade unions early and often, rather than trying to limit the ability of working people to stand up for themselves and their employment rights.
But they have these arrangements in other countries like France, Italy, Spain. It doesn't seem to be a problem there.
I think that the hoops that our UK workforce already have to jump through in terms of being able to get a legal industrial action ballot far beyond those in comparable countries. And this is just another poor attempt by the government to limit the working class ability to stand up for themselves. We don't leave services in dangerous or unworkable positions, but it comes to say something when people that are working for the NHS feel that the only option to get their government to listen to them is to take industrial action. Industrial action is the last resort for most people, especially those working in the service sector. But if you can't force your employer to listen with meaningful negotiations, then there's only one option left for the workforce.
OK, Charlotte, we've got to leave it there. Appreciate you joining me this afternoon. Thank you.
Yeah.
Some other business news stories for you now. And Ryanair is to start paying regular dividends to shareholders as its strong post-COVID recovery continues. The news came as Europe's biggest airline, which has paid one-off dividends in the past but not regular ones, reported a profit after tax of €2.18 billion for the 6 months to the end of September. That was a record and up 59% on the same period last year. Well, Ryanair carried a record 105.4 million passengers during the period. That was up 11% on a year ago. It's targeting 300 million passengers a year by 2034. Well, it comes as a new report reveals London as being the most searched for destination for flights globally this year. According to the travel booking site Apodo, Paris was the most booked destination in front of Barcelona and London. And almost half of travellers left it too late to book their trip, with 44% of bookings made within 2 weeks of departure. Well, speaking to me a little earlier, the chief executive of Thomas Cook, Alan French, said global tourism was returning to levels seen in 2019 before the pandemic.
We are seeing it holding steady. Looking into next year, we're seeing the same trend continue. And even though there's a cost of living crisis going on, it's good to see people are actually valuing the time they have spent with their families, doing the things they enjoy, perhaps over other discretionary spend. So I think we're looking at 2024 fairly bullishly.
House building activity in the UK fell last month to its slowest pace, excluding the pandemic, since the global financial crisis. The Purchasing Managers Index survey produced by S&P Global, in which anything above 50 represents growth and anything below that a contraction, came in at 45.6 for October. That was up from 45 in September, but was still the second lowest reading for the construction sector since May 2020. Well, within that, house building decreased for the 11th consecutive month and at a much steeper pace than elsewhere in the construction sector, with a reading of 38.5. The UK is some £615 billion short of the funding needed to achieve its ambitions in energy, transport and housing infrastructure by the end of the decade. That's the conclusion of research commissioned by the Association of British Insurers and the Investment Delivery Forum, the body that brings together major insurance and long-term savings firms with an interest in large-scale infrastructure investment. It found that while more than £1.3 trillion will be needed, only £700 billion worth of funding is forecast to come from a mixture of public and private sources. Well, joining me now is Hannah Gurger, the Director General of the Association of British Insurers. Hannah, good to see you this afternoon. Briefly sum up for me, if you would, please, what this £1.3 trillion will be needed for.
Well, good afternoon, Ian. It's great to be back with you. The 1.3 trillion is the figure that's been identified in the research our Investment Delivery Forum commissioned to see what investment is needed if we are to get where we need to as a country to meet our net zero targets by 2030. The investments needed for transport, housing and energy, but the good news is that although there is a shortfall of £615 billion, the insurance long-term savings industry has already committed to invest £100 billion following the implementation of regulatory reform through a new piece of regulation called Solvency UK. So we are ready as an industry to do our part, but there's no doubt that more funding will be needed if we are to get the infrastructure the country needs.
I mean, interestingly, looking at your research, it's housing where the greatest shortfall is. It's not energy or transportation.
Well, there's a huge need both for building new housing, as you've just covered in your previous segment, but also to retrofit the insulation to our existing housing stock. The insurance and long-term savings industry has already made a large-scale investment across the country into sustainable and affordable housing, but we definitely need more. And it will be interesting to see what we hear in the King's speech tomorrow, whether there will be any announcement about how planning might be made more easy for people and businesses across the country to make the investment to build the homes that we need.
Hannah, you mentioned just now there is new legislation, Solvency UK. How, for those who aren't up on the details here, how will that improve the investment outlook?
Solvency UK is the prudential regulatory framework for insurers, and the changes that the government and regulator are introducing will mean that insurers can invest in a broader range of what we call productive assets. I like to think of them as green and good projects, whether that is EV charging infrastructure, offshore floating wind. Those are the sorts of things that the new regulatory framework will allow insurers to invest in more often and more regularly.
But I think from your research, that's only going to free up another 100 billion or so. That still leaves a shortfall of £500 billion.
There is a shortfall, which is across both private and public sector, but the research we've released hopefully identifies that there is a need, there's a challenge that needs to be met. And as an industry, we are committed to playing our part. And we want to make sure that we're identifying as quickly as possible the projects that need that investment. One of the things we've identified through the work of our Investment Delivery Forum is that the pipeline of projects across the country is one where the needs of insurers are not always understood. If you think about insurers, we are investing for the long term. We need regular, predictable income because we're looking to safeguard people's futures. It's their pensions that we're really talking about. So we're working closely with local authorities, organisations like the Scottish National Investment Bank and others to make sure that the needs of insurers are understood by those people and organisations that are developing the projects.
It's a good point you make there. I mean, after all, your customers, the people whose long-term savings your members are managing, I mean, they do need a return on their investment. Is the private sector just being asked to do too much?
We do need to put savers' interests first. That is a priority for the members that I represent. But if the return is there, I think we'd all want to make sure that we are seeing more investment going into areas where our economy and society really will benefit, whether that's housing, whether that is our energy network, whether that's our charging infrastructure, so more people can have confidence in using electric vehicles.
I mean, we've already seen the Prime Minister pushing back the date for implementation of things like the phasing out of gas boilers, the phasing out of new petrol and diesel vehicles. Would similar, restating of targets elsewhere make this situation easier?
I can only speak on behalf of the members I represent, and certainly the UK insurance industry is committed to net zero. Back in 2021, the ABI produced a climate change roadmap. That sets out the milestones we as an industry are working towards to get towards net zero. So our commitment remains.
Hannah, what about the funding requirement post-2030? I mean, we've talked a lot about this 1.3 trillion that's needed before then. What does it look like after 2030?
Well, that's a really important question, Ian. And the research indicates that at the current rate of investment, that gap is going to widen. That's why we felt it was important to release the findings now so that we can work together, private sector with public sector, to find ways of meeting that challenge and finding opportunities for firms and for public sector to invest so that we can get ourselves to the net zero economy that I think we all want.
OK, Hannah, got to leave it there. Appreciate you joining me this afternoon. Thank you.
Thank you.
Well, still to come here on Business Live, we'll have a look at how the markets have done this Monday. Don't go away.
Play Sky News.
From the Sky News Centre at 7.
Now that you're up to date, we can go into a bit more detail.
Things can change incredibly quickly.
Taken by surprise.
Have you ever known a moment like this in British politics before?
Yes.
Cheers. We'll start with breaking news.
Let's get the latest on the ground.
So, by the end, we'll hopefully all understand what's going on in the world just that little better.
They have breached the road. There is a lot of gas being fired all around us. It is an absolute carnival kind of atmosphere out here for Prime Minister Modi's decisive victory. These students are defying the prohibitory orders, and now they're going to be arrested. We aim to be the best and most trusted place for news. The roads have been inundated. The only way out is to get people by boat. What is feared that over 200 people might have died because of these landslides. This on any given day would have been bustling with people, but today it's absolutely deserted. This is one of the most sensitive areas of northeast Delhi where there's been clashes. I'm Neville Lazarus and I'm Sky's reporter based in Delhi.
Five of us have made it out of the car.
Welcome to Backstage, the film and TV podcast.
Fly Emirates, fly better. Fly Emirates, fly better. Thank you.
Well, after last week's stellar performance, stocks in Europe have made a somewhat muted start to the week. All of the major continental European indices have finished in negative territory this afternoon. Talking points include Telecom Italia. The shares have fallen by nearly 3% in Rome after it agreed to sell its fixed-line network to the private equity giant for KKR for €19 billion. The shares are actually lower, though, because the deal is not being put to a shareholder vote, and not everyone's happy about that. Here in London, the FTSE 100 has finished more or less unchanged right now in mixed trades. The biggest percentage gainer today was Melrose. The shares rose by just over 3.5% on news of a new $5 billion partnership with aircraft engine maker GE Aerospace, while Standard Chartered, which sold off after its recent results, has been attracting some bargain hunters. That's up 2% at the close. To the downside, the student housing group Unite has run into profit-taking after last week hitting a three-month high. That's down by about 4%. Outside the FTSE, EasyJet, Wizz Air, both up on the back of Ryanair's stellar numbers. Ryanair itself up by more than 5% right now. TUI was in positive territory. It's given that backer secession's gone on. Elsewhere, lower down the corporate food chain, Mosman Oil and Gas is off 7%, following a disappointing production update. Meanwhile, Hypnosis Songs has finished 1.5% lower on news it will not declare dividends before the new financial year. Over on Wall Street, you can see the Nasdaq on the screen right now. All the main stock indices have opened to the upside, although one of the main talking points this afternoon is a faller, the dating app Bumble. Its shares have fallen by 7%, and that was after its founder and chief executive, Whitney Wolfe Herd, unexpectedly announced that she was stepping down. Meanwhile, shares of WeWork have been suspended ahead of an expected filing for bankruptcy protection by the co-working space provider. On the foreign exchange markets, well, the pound this morning traded above $1.24 for the first time since the 21st of September. It's clinging on to that now. It's about 0.1% higher against the US dollar. It's about 0.1% lower against the euro. The single currency, meanwhile, up by about 0.1% against the greenback. As for the oil price, well, that is firmer after Saudi Arabia and Russia said at the weekend they will continue with voluntary production cuts. A barrel of Brent crude will currently cost you $86.06 a barrel. That's up just shy of 1.5%. Well, joining me this afternoon is Eleanor Ingleby, head of high net worth at Atomos. Ellie, good to see you again. Let's start with Ryanair. I mean, solid numbers to say the very least, and a dividend.
Very solid numbers and a maiden dividend, which the market always likes to see. I think what's been interesting is obviously passenger numbers have gone up by around 11%, but also they've increased their prices by around 24% over the last 6 months. They've been really able to capitalise on that resurgence in confidence as people start to have more certainty they can get abroad easily.
I mean, it's just a stunning story, this. I mean, I remember talking to them all the way through the lockdown period, and they didn't sack people like some of their rivals did. They put everyone on furlough on a reasonable amount of pay. They've now made up their pay, and they carried on investing. It's no surprise, really, to see them doing better than they were prior to the pandemic.
No, it's really reassuring to see, and I think that good behaviour has been rewarded. But I think it's also not been clear skies ahead. I know that the boss has spoken about the challenges of, ordering some of the Boeing planes that are not arriving in quite the time they're expecting, and the challenges of oil prices and the effect that's going to have on fuel and costs. But really, it's been lovely to see some confidence come back into that industry.
Absolutely. Now, another story that caught your eye today was NatWest introducing an AI chatbot.
It's really fascinating. So NatWest have introduced, or they've had around for a little bit, a chatbot called Cora. And they're introducing an addition to it, which is powered by IBM. And this is generative AI. So similar to ChatGPT, it almost feels like you're talking to a human. And what has been fascinating is that they've said they don't expect to see any job losses as a result of it, that customers will still be able to call up on the phone. And obviously, NatWest have closed, I think, over 100 high street locations over the last year. So it's lovely to see that integration of AI coming in more.
But the timing is interesting because only a few days ago, Elon Musk was telling Rishi Sunak, you're not going to need to work in the future thanks to AI.
I think Elon Musk is seeing quite far ahead into a future that maybe isn't as clear to the rest of us.
Yeah, quite agree. Now, over on Wall Street, a couple of interesting stories. One of them, WeWork. I mean, it looks like it's pretty much game over for this business.
And we've been hearing rumblings for a while. I don't think it's coming as an absolute surprise. But I think what would be fascinating is what happens to their property portfolio and what effect that has. We all know that due to hybrid working coming in, it was an expectation that is going to shift the way that cities and infrastructure work around it. So I think investors will be watching that very closely to see who starts to pick up some of the parts from them.
But what happens to those existing deals that they have with landlords, some of whom presumably are here in the UK as well?
I think those are open to negotiations, aren't they? This is such early stages, it's very hard to say what path it's going to take. You hope that they've found the right credit companies to get them through this next stage. It's going to be very tough.
I mean, looking back on this story, it's quite incredible how many people fell for the notion that this was some sort of tech startup type thing when it was, in fact, just another property company.
It was to a certain extent. It won't be the first company that's sold an illusion and then found that actually the environment can be tough. And it has been a very tough environment the last couple of years, and particularly in property. So if you're more bricks and mortar than you are tech, you are going to find those challenges.
Yeah, that's not to say that a lot of property companies are not very entrepreneurial, because they are.
Incredibly so. But I think it's that more transparency of what they're doing. But I think rework, it would be very fascinating to see it unfold further and actually do some analysis on where things slightly went off kilter.
Yeah. Now, elsewhere in the US, of course, we heard over the weekend about Berkshire Hathaway, Warren Buffett's investment vehicle, now sitting on a record cash pile. I think it's about $156 billion.
Yeah, it is. And obviously everyone watches what happens in Berkshire Hathaway. We actually hold a portion in our portfolios. Warren Buffett has proven himself again and again as being an incredibly astute investor. And I think it says a lot that he is quite happy to hold that cash and potentially look for opportunities and stay quite liquid.
Do you think it means that he is building up for some sort of big acquisition if he sees asset prices coming into line with what he'd like to pay?
It could well be that, and I'd love to have an insight into Warren Buffett's head. I think it'd be a great thing to do, but I know that, again, we'll be watching him with great interest to see what moves he makes, but we certainly have a lot of confidence in him.
Yeah, and again, Wall Street, fantastic week last week. Looks like it's continued into this week.
It really has been. It's lovely to see a bit of more movement in the markets. It's been quite a tough year of nearly flat. We've certainly seen some pockets like Japanese equities and such, where we've seen a bit more buoyancy. But certainly Europe and the UK have struggled a little bit more.
OK, Ellie, got to leave it there. Good to see you again. Thank you. That's it from me. I'm back again with Business Live tomorrow. We don't have a programme tomorrow morning at 11:30 because there's going to be special coverage of the King's speech. Sorry about that, but we will hopefully be back at this time tomorrow afternoon. Hope very much to see you then. In the meantime, do stay tuned. Coming up after this short break, it's Jonathan Samuels with the News Hour. Thanks for joining me today. Cheerio.